March 2020, the S&P 500 drops 34% in just 23 days. People panic, sell, lose half their life savings, and swear off stocks forever. The smart ones, the quick ones, did the opposite. They bought a lot. Those who invested lump sums at bottom made 2 to 3 times your money in the next 3 years. The difference was not luck, it was preparation, mindset, and simple playbook most people never learn. In 2026, crashes are not if they are when. AI bubbles, rate surprises, geopolitical shocks, recession fears, something always breaks eventually. The question is, will you be the one panicking or the one quietly getting rich? Today, I'm giving you the exact step by step playbook rich investors and institutions use to turn market crashes into massive wealth legally, calmly, and without gambling. No timing the bottom, no YOLO options, no praying for a miracle, just proven, boring, high probability moves you can start preparing for right now. If you ever watched your portfolio drop 20% and felt sick, this video is for you. Stay until the end. I'm giving you a 2026 crash readiness checklist you can run this week so you are ready when the next one hits. Let's go. First mindset shift. Crashes are not disasters, they are sales. Even every major market crash in history, 1929, 1987, 2000, 2008, 2020, 2022, was followed by the strongest recoveries on record. The S&P 500 has never failed to make new highs eventually. The average bear market drop is 37% and lasts about 14 months. The average bull market gain is 112% and lasts 5 years. So, statically, every crash is temporary discount on the long-term trend up. Rich investors don't fear crashes, they wait for them. They keep dry powder, cash or low risk assets, earning 4 to 5% high yield savings or short term trades right now, ready to deploy when bullet is in the streets. Rule number 1, build your war chest before crash. You need three things in place. Number 1, true emergency funds, 6 to 12 months of essentials in high yield savings at 4 to 5% APY. Do not touch this for investing. Number 2, opportunity fund, extra cash you are willing to invest during a 20% or more drop. Aim for 10 to 30% of your net worth, depending on your risk tolerance and age. 3, margin of safety in your existing portfolio. Keep your allocation conservative enough that you don't have to sell at the bottom. Rule number 2, have a written buy list ready. The biggest mistake people make in crashes is freezing, too scared to act or not knowing what to buy. Create a watch list now of high quality, low cost ETFs or stocks you would love to own cheaper. For example, in 2026, VTI or VO for broad US market, VXs for internationals, VNQ or SEHH for the real estate, BND or TLD for bonds if you want safety. Individual names if you research deeply. Apple, Microsoft, Nvidia are emerging AI leaders. Write down price targets. 20% of all-time high, 30% or 40% when the market hits those levels. You already know what to buy and how much. Rule number 3. Use dollar cost averaging aggressively during the drop. Don't try to catch the exact bottom, nobody can. Instead, commit to investing a fixed amount every week or month as prices fall. In 2020, those who dollars cost average from February to October ended up far ahead of people who waited for the recovery. In 2026, you can automate this in Fidelity, Vanguard, Schwab, or any brokerage set recurring buys on dips. Rule number 4, rebalance mechanically. When stocks crash, your portfolio drifts, bonds or crash becomes a bigger percentage. Rebalancing forces you to sell what went up and buy what fell. It's buy low, sell high automated. Do it quarterly or when allocations dip 10 to 15%. In crashes, this move alone can add 1 to 2% extra annual return over time. Rule number 5, avoid 3 killer mistakes. Number 1, selling to go to cash after the drops has already happened. You lock in losses and miss a rebound. Number 2, going all in one margin or options during volatility. You can get margin card at the worst moment. Number 3, panic buying. The dip too early with money you can't afford to lose. Keep your emergency fund scared. Rule number 6, think indicates, not days. Every crash feels like the end of the world in the moment. But zoom out, the S&P 500 has done about the 10% annualized since 1926, including every crash. AI is accelerating productivity, long-term trend is still up. Your job is to survive the storm and own more of the recovery. Quick 2026 crash readiness checklist. Number 1, do you have 6 to 12 months essentials in high yield savings at 4 to 5%? Number 2, do you have an extra opportunity fund ready 10 to 30% of net worth? Number 3, do you have a written buy list with target prices? Number 4, are your recurring investments set to buy more when prices fall? Number 5, is your portfolio set up to rebalance automatically or quarterly? Number 6, have you mentally rehearsed what you will do when your portfolio drops 10 to 20 to 40%? Crashes are not the enemy, they are the best wealth transfers events in history. They transfer money from the fearful to prepare. If this change how you see the next step, hit like, subscribe, comment. How much opportunity cash do you have right now, and what is the first thing on your buy list? I did everyone. Thanks for watching. The next crash is not coming to hurt you, it is coming to reward you. Be ready. See you next time.